All right, so Wall Street just reminded us that apparently optimism has its limits. So after 3 days of red, stocks finally bounced back, closing in the green territory, but this wasn't because risks just up and disappeared out of thin air, but because investors chose to look beyond the data we got today regarding inflation, the news on new tariffs, and the constant tug of war between economic strength and fragility. So the relief rally was real, but so are the cracks forming beneath it. So today we're going to cut straight into the numbers, the policies, and the Fed's own internal divisions that are shaping where things are going next. So today the S&P 500 closed up 0.6%. We've seen the Dow gain about 0.7%. The Nasdaq added 0.4%. But really, what set the tone today wasn't just the green on the screen. It was Washington's latest move, which was a fresh round of tariffs. Because, we haven't heard about those in quite a while. So, they just had to press that tariff button and stir that pot up a little bit. So starting Wednesday, as early as next week, the U.S. will slap a 100% levy on certain pharmaceutical imports. Let me click off of this sucker right here. I'm even on the wrong screen. And those pharmaceutical imports will be specifically branded and patented drugs from companies not building plants in America. And then add to that 50% duties on kitchen cabinets, 30% on upholstered furniture, 25% on heavy trucks. So the carve-outs are narrow, but the message is pretty broad. Protectionism is back in force, everybody. And despite this, the rally showed investors just aren't concerned. There's no panic about these higher costs that are going to come from this new round of tariffs. Then we also got some inflation data. So now to the inflation print that markets were waiting for, which was the Fed's preferred gauge, the PCE index, personal consumption expenditures. And what we've seen is that index rose 0.3% in August. The core measure, stripping out food and energy, those volatile segments that matter more because that's what people spend all their money on, that rose a softer 0.2%. So both, really everything in this report came right on target with Wall Street's forecasts. Year over year, the headline rate ticked up 2.7% year over year. Core inflation stayed stuck at 2.9% year over year, and that's still way above the 2% goal of the Fed, but it's not running hot enough to justify any panic, at least right now in time. Now we got these new tariffs being announced. Who knows how they show up in the data later, and we don't even know for sure that the current tariffs that have been in place are going to show up in the data, or if they have yet, or if it's going to be a little bit later down the road. Some are expecting later down the road, if you're like Raphael Bostic in the Fed, for example. But the details in this report matter. So goods prices, which are the most tariff-sensitive category in this report, they barely moved, with being up only 0.1% after falling in July, which is pretty encouraging. Services inflation, on the other hand, logged a second straight jump of 0.3%, and services are usually less affected by tariffs, which means this isn't about trade policy. It's about domestic costs like wages, insurance, repairs, and those are creeping higher, and that's the part that could become a thorn in the Fed's side, at least for the Fed, if we see the inflation increasing, which inflation is the rate at which price is increasing, persisting. Now, the Fed's positioning is that the Fed cut rates last week for the first time this year, despite inflation still running above target, because we've seen the labor market has softened. But with Friday's data, the situation could look a little bit less urgent. So most officials are expecting inflation to peak near 3% before cooling into next year. And the real nightmare scenario would be a resurgence in inflation that forces at least the threats of, all right, we're probably going to have to start thinking about rate hikes again. I don't think they do it at this point in time with the current environment set up, though. I'd say that's just my opinion, I guess, but I think that's way out there. If they even started talking about that, like, everybody would just roll their eyes at it. Like, really, bro? Y'all aren't going to do that. So for now, the path forward hinges on two reports as early as next week. They're starting, so September's job numbers. So let's just pull up Market Watch real quick. On Monday, pending home sales, we got, where's it at? ADP as early as Wednesday, so mark your October 1st on the calendar. Then we got initial jobless claims Thursday, October 2nd. And then Friday, that is the day because Friday we'll get the jobs report, the unemployment report. And then aside the jobs numbers, we also got the CPI release to watch out for before the Fed actually meets again. So that'll be important because unless inflation flares up, we could justify cutting rates and being on target with the cuts that the market's been pricing in and the Fed's dot plot. But if inflation starts flaring up and going up higher, that could be tough, and that's the balancing act that Powell and his team are walking right now. Jobs and inflation, and which one should we focus on? Which one's more out of place? Now, within that PCE report, we get information on households and in regards to consumer spending and income. Now, while the Fed debates, households are keeping the economy afloat. So we've seen personal spending rising 0.6% in August, which it was the third straight monthly gain we've seen. People are dining out, they're traveling, they're even buying RVs. So it's all good as long as people aren't selling their homes to live out of RVs because they can't keep up with these rising costs. Then at the same time, we've seen incomes climb. They've climbed 0.4%, meaning paychecks are rising faster than inflation after underperforming inflation forever. So yeah, it looks good on the headline, but when you really look at the numbers line to line, it's not adding up. But higher transportation costs from car repairs to airline fares, they ate into people's wallets, but not enough to dent overall demand. And this resilience matters because consumers are spending, their spending drives 2/3 of US GDP, and right now it's still running at levels consistent with steady growth. And even in the face of tariffs and high prices, they're still able to do that. But not everyone's convinced that the consumer's doing pretty well. The University of Michigan's consumer sentiment dropped today, and the consumer sentiment index dropped to 55.1 in September, sliding back towards April's lows when tariffs were first hit. They were first really put into place. And worries about the labor market are weighing on households, with hiring slowing and job creation beginning to lag. And interestingly, the only group whose sentiment held up better was households with large stock portfolios. So in other words, asset wealth is cushioning perceptions at the top. So it's the rich people, while the average Joe and Janes, they're really feeling the pinch of this economy. Then Michelle Bowman's take, there was Michelle Bowman out there, and I was reading through this and it was pretty interesting what she had to say, but there's this internal debate going on and she laid out her case today. So the labor market, she sees fragility regarding the labor market. She mentioned the payroll revisions and months of weakening job growth as a signal risking of deeper deterioration going forward. Then on the inflation front, she believes tariff-driven price hikes are one-time effects. They're not going to last, in her opinion, and that core inflation will naturally return to the 2% target over time. And then on Fed policy, she pushes for moving rates towards the neutral rate sooner than later, and she's warming to that waiting risks put the Fed behind the curve, so she rather jump ahead of it sooner than later, like I just mentioned. Then on productivity, Bowman flagged the AI-driven surge in investment as a structural boost to output, another reason not to over-tighten. And then on the balance sheet for the Fed, she favors shrinking the Fed's footprint, holding mainly treasuries and keeping emergency tools strictly temporary to avoid distorting markets. And her speech really underscored the divide that underlies in the Fed. We got Powell being cautious. Myron wants aggressive cuts. Bowman is urging for proactive steps to protect jobs while trusting inflation to ease. And then we got people like Bostic, who's I'm not really feeling any cuts right now. So the Fed is fractured, but the cracks in strategy are beginning to widen. So what do we have, everybody? We got a lot. Markets are brushing off tariffs and sticky inflation, so that's a good sign for now. Then at the same time, consumers are spending freely, supported by their rising incomes. Inflation stuck just under 3%. It's coming right in line with the expectations, with services being the wild card. A Fed split between patience and urgency and forward-looking caution. And the next catalysts are pretty clear. We got September jobs, and the inflation data. So until then, expect markets to swing between resilience and fragility, just like the economy itself. It's a reflection. It's a voting market. And how people feel is how it begins to show up through all of these different moving pieces in the economy, in the data, in the stock market, in spending. But today's rally is real, but it's sitting on a ground that's shifting beneath our feet. And all we could really do is observe, witness, read, hang out together, talk about it, and keep coming back for more, everybody. Thanks for hanging out with me. It's always a pleasure to have you here, and I'll see you next time. Hope your weekend's awesome.